Oh my god. Last night, went to bed, Bitcoin 104K. This morning, I saw 98K and it was horrible. Okay? I'm so tired of this market.
Not gonna lie, I think we topped.
Hey,
At this
hey,
point,
hey.
every single day, I'm starting to believe it more and more.
Look, this is a very difficult cycle and we have so much to discuss. This is a safe space. Come on in, grab your cup of coffee, let's talk it out. I swear to God, this is so relatable. No rate cuts, dump. Rate cuts, dump. Tariffs increase, dump. Tariff decrease, still dump. Good news, dump. Bad news, super dump. No news, dump. Absolutely horrible, man.
Crazy.
But look, if you got stopped out, you got liquidated, hey, I'm sure you're doing way better than this guy. Okay, this guy shorted Korean fried chicken companies. He lost 472K shorting Korean fried chicken company because his thought was with a declining Korean population, recent trend towards healthier eating and vegan diets, there's an opportunity here. Did his full research into consumer trends in Korea. Think this was the play. And then remember 2 weeks ago, Jensen Huang and a couple of other CEOs went to have some Korean fried chicken. They can't even eat in peace. Paparazzi snapping photos of them eating Korean fried chicken. And man, these chicken companies pumped really hard. And bro got stopped out, lost 472K. Okay? Bro, like, this is actually so embarrassing. Imagine you like you have to live with that for the rest of your life. Imagine losing nearly 500K shorting Korean fried chicken. All right, so boys, welcome to the live stream. What the hell is going on? Why is BTC nuking to 98K and now it's trading at around $101,900? So we have prepared for this scenario. This is a normal scenario because we looked at the weekly where the macro support is the bearish to bullish key level, the open close. This is our key level. As long as we trade above here, this will be the new range for the foreseeable future. But what sparked this? And I think this is actually good that we have this dump now. If there's going to be an aggressive correction, it has to be now, right? So I think two important events, if you haven't heard, two important events that sparked, I'd say, this massive sell-off again. Number one, Michael Burry. Christian Bale, famous for shorting the housing market in 2008. There's a big movie about it. If you haven't seen it already, you should watch it. It's called The Big Short. Really, really good movie. So he came out and he said he had $1 billion in puts, in options, shorting AI stocks, namely Nvidia and Palantir. When he comes out with news like this, usually everyone's are like, especially the people who watch The Big Short, including myself at first, I'm like, oh fuck, shit, it's the AI bubble. But then again, I said, I don't think it's the AI bubble, and we're gonna discuss that, okay? Number two reason why we are dumping again is this week you have a bunch of FOMC members having their talk during US market open, right? And look, a lot of them are thinking more hawkish than expected, and this is usually good for currency. And if it's good for currency, it's not good for risk on assets. This includes equities, this includes crypto, all right? DXY soaring to 100. The US dollar is gaining strength. We don't want to see this, man. Right? They have their arguments. We're going to go over them. But we also have our counter arguments as to why I think, honestly, I think, fuck you. You have your short position. It's so obvious. Okay? Okay. All right. Number one, let's talk about this. Christian Bale betting $1 billion on AI bubble bursting. This is a good article that sums up basically why he thinks there is a possible AI bubble. Okay. Yesterday's live stream, we talked about Palantir earnings have beat market expectation, really strong revenue coming out. And then you have just so many AI deals coming through, and looks like it's going to be very bullish for AI, right? But then you have Michael Burry thinking this is a bubble. Yeah, Monday he posted this picture chart titled US Tech Capital Expenditure Growth is Matching the Tech Bubble of 1999 to 2000, and another showing how growth in demand for cloud computing at major tech companies is slowing. So this is his thesis as to why he's shorting AI stocks and why he thinks it's an AI market bubble, because he thinks it's pretty much the exact same bubble that happened in 1999.
This is the dot-com bubble.
The dot-com bubble, exactly.
Overhyped.
Basically. Exactly.
The only difference between the AI bubble and the dot-com bubble, I would say, is at least for the AI bubble, AI companies are actually generating revenue.
Yeah.
Right? Because during the dot-com bubble, there were businesses and companies IPOing with no business model.
Yeah.
So zero revenue, just all hype. At least this one is making money.
Back in 1999.
Yes.
Exactly like what Martin said. So this is the first counter argument as why we think, Michael Burry is not looking at all the variables here. Okay. Major distinction from the 2000 dot-com bubble is that leading AI players aren't just speculative. They're generating substantial revenue and profits. And guess who's saying the same thing? Jerome Powell. Okay. He said it in a conference. He said, unlike the dot-com bubble, AI spending isn't a bubble. All right. I won't go into particular names,
but they actually have earnings.
They have earnings.
I've heard this.
Yeah, this reel went viral on Instagram, on X. I'm sure you've seen this reel where Jerome Powell said they actually have earnings, right? And we know this for a fact, bro. We're subscribing to multiple AI platforms. Everyone is hooked into AI. Right? It's so fun using AI, especially these days with turning images into videos, right? And this ties in with reported record data center revenues driven by AI chip demand. So it's not just AI here. We're looking at data centers. We're looking at energy companies. Now is the AI era. And what powers AI to be smarter is energy, is electricity, is power. Right? People think intelligence is the commodity. It's not. I think power is the commodity. You need AI to become smarter. You need AI to become more intelligent. You need electricity. You need high amounts of energy, high amounts of power. So if you're looking at equities, I think pay attention to the ones that are energy companies. So that's counter argument number one, is they have real earnings and fundamentals. Balance sheet is out there, you can see. Right? Yesterday, we saw Palantir earnings beat Q3 market expectation. Number two, rapid adoption and real-world productivity gains set AI apart. It's undeniable that almost all of us are subscribed to some form of AI tools. Capital expenditure surge is strategic infrastructure investment, not irrational exuberance. So this is counter argument number three. Michael Burry is saying that the tech capital expenditure is the same as the dot-com bubble. All right. This can be seen as necessary build-out for long-term growth, similar to how internet infrastructure investments in the late 1990s paved the way for today's digital economy. AI requires massive data centers and computing power. Exactly, that's what I'm talking about. And while growth in cloud demand may be moderating from peak levels, it's still robust. Major providers like Amazon and Google Cloud report double-digit increases in AI-related services. So, if earnings per share in the future is going to be favorable for all tech stocks, then we're going to be experiencing drawdown now. Like, it has to be now, then send up. This would be the corrective phase for stocks. And that translates into crypto, right? Experience it now, then we send it up. That's what I'm thinking. Even if there's short-term overinvestment, historical bubbles like .com produce winners. Amazon, Google, that emerge stronger post-crash. AI's capital expenditure is backed by demand forecasts. And then Talking about Michael Burry's timing and past calls suggest caution. Look, everyone knows, right? The Big Short movie. He made a big win, but remember, he has been wrong multiple times.
A lot of times.
A lot
He
of
tweets
times.
a lot, actually.
He tweets a lot, right? Go follow him. After 2008, he's been wrong multiple times. The 2017 global financial meltdown. What did he do? He said the economic collapse that could lead to World War III, stating his logic pointed to an imminent systemic failure. Did not occur. 2019 index fund bubble. He warned that it was a bubble, similar to subprime CDOs, right? Then what happened? The next year, S&P 500 rose 15%, which is huge. Then what? March 2020, bearish bet during COVID-19. Michael Burry shorted, expecting a prolonged downtrend. What did the S&P 500 do again? Or 70% in the next year as stimulus and recovery took hold. June 2021, the mother of all crashes, and I remember this. He tweeted this, right? He forecasted massive market plunge for S&P 500. What happened again? S&P 500 just climbing, right? Then maybe you joined in crypto recently. 2023, he tweeted this. He just tweeted one word, sell. What happened throughout the year? It rallied. Stocks rallied. That was the start of crypto bull run too. Do you remember? 2023. This was January 2023. Green. February green. March green. April green. May bearish. But next month bullish. Next 2 months bearish. But then September 2023 kick-started the bull run of crypto. Right? Next thing to note is, number 2 is FOMC members are more hawkish than expected. It's good for currency, which is weird because it's still government shutdown. So feds don't have access to labor market data. How do they know if it's going to be hawkish if they don't have all of the variables? Why are FOMC officials talking about inflation despite a data blackout? So, short answer, key US agencies have been shut down. So the Fed is missing the usual CPI, PPI, retail sales, and job releases. These are very important variables for them to know if they need to cut rates or not. But we don't have access to them. Why are they hawkish? Because several of these governors and regional bank presidents keep flagging inflation risks because private and high frequency indicators still point to sticky prices. Tariffs are mechanically lifting core goods costs. The committee wants to anchor expectations and defend credibility while policy is driving in the fog. Publicly stressing inflation buys optionality for the December meeting and discourages markets from assuming an automatic easing path. This is why we're seeing the rotations into currencies. US dollar getting stronger, especially the past few weeks. They're rotating now from risk assets into currencies. It's not just Bitcoin. Look at gold. Gold, from then on, plummeted. It's still on a downtrend, right? Still on a downtrend. We don't have a break of these local highs. Now it's kind of creeping back up, but overall, still on a downtrend. I think the takeaway here is the markets are not trading technicals. They're trading sentiment. These are overreaction from investors rotating so that they can get the best bang for their buck. For crypto, look at this. Even though prices are dropping now, Bitcoin, dominance is creeping back up for BTC. BTC dominance is creeping back up towards above 60%. So it's expected we will break here to maybe potentially fill the majority of this wick. And another thing is USDT dominance. Huge pump for USDT dominance. So what does this mean? It means a lot of people are selling their assets for USDT, right? Whether that be Bitcoin, whether that be Ethereum, whether that be Solana, or any kind of altcoins, they've sold into USDT. That way they can just park it in a yield farm. Just might as well earn some USDT now than going through the headache of like speculating on prices. Right. All right. So I guess that's it. Remember to follow me here on X. Subscribe to my YouTube channel. That's Ron Trades Official. We'll be posting more there. Take care of yourselves, guys. And yeah. My name's Ron.
Martin,
Shana now.
peace.